Hi, everyone. This is Jeff Praisman with IBKR Podcast. It's my pleasure. Welcome back to our studio, Dmitry Pargamanik from Market Chameleon.
Hey, Jeff, how are you doing?
We just got done a great webinar on earnings screenings through option activity, and we have the opportunity, as we do every month, to take a deeper dive into it, having the podcast studio. So I'm excited. And, we probably should just start with the obvious question, right? So why analyze historical option strategies around earnings? What is the benefit?
When we look at options, it's a unique instrument that allows you to either hedge or make an outlook on a binary event. And earnings are binary events. They come once a quarter, so you got them usually 4 times a year. And around earnings, the stock and the options behave different, especially because you have this earnings announcement. And after the earnings announcement, right before that, you have this high uncertainty. Then you get this news, and the stock can reprice very quickly and move to a new level. And that itself is different than what a stock will behave from day to day when you don't have earnings announcements. So just isolating those specific earnings dates and earnings announcements and analyzing them on their own is important. And it gives you a different opportunity to use options around that binary event.
So what key metrics should the traders prioritize when they're analyzing historical option strategy performance during the earnings seasons? Also, like why they're crucial for informed decision making.
Yeah. And there are different metrics available depending on what question you're trying to answer. But typically around earnings, the most important or the most frequently looked at metrics would be stock price movements, the volatility or the gaps. How much volatility does the stock experience even heading into earnings? So is there an uptick in volatility maybe a day or 2 days before the earnings? What type of volatility or gaps do we typically see after the stock closes? Usually the stock closes, you see an earnings announced after that market closes or before the market opens, and then you get this gap move. And the volatility right after the market opens, you're going to see some more volatility more than usual because you got this repricing going on. And you also have repricing of options, and how long does it take to get to those normal levels? So these are metrics we look at in isolation, and maybe depending on what question we'll learn to answer, but you'll typically see the metrics on volatility, stock price movements, the magnitude of the moves, and the premiums and the options, how the premiums behave going into their earnings and coming out.
And are the metrics able to indicate a bullish or bearish positioning?
The positioning themselves would depend on the actual strategy of the option. So if you're looking at a bullish positioning, you would do something like maybe buying a call or a call spread or some kind of a strategy that has a bullish outlook, or you could have a bearish outlook with options, and you could also have a direction neutral strategy, but something that is looking at a movement in either direction, such as a straddle, where you're looking at the magnitude of the move either up or down. So that really is more based on the way you strategize with options.
And how do the historical screening tools help identify optimal entry points for option strategies to the earning dates?
Yeah. So when we look at option strategies, it doesn't, and a lot of people typically think of, right before earnings and right after, but the options can behave and the stock can behave differently, even leading up to earnings. It doesn't have to be right before. You could have a strategy that avoids earnings completely, but you could do something like 3 days before earnings and right up to the end, right before the close, before the announcement or coming out of the earnings. And that's important because even though you have this earnings event, you may want to take a look at how these strategies line up and what are your potential risks and rewards around those or anchored around that earnings. Is there potential there or an opportunity even heading into earnings because maybe there's like lower volatility in the options in the stock and they're lined up well? Or do you go and hold a strategy all the way through the event, or wait till the event is over? And maybe there's a strategy there where it takes, the options take longer to trade back into their usual implied volatility, or is it overdone? So these are things that you could start looking at for different time frames.
And, what indicators suggest the best timing for strategy implementation?
And that would, obviously we can't time, but from a historical perspective, we could take a look at it, and like sometimes you may see where a bullish strategy, even from a historical perspective, might have been better off waiting for the release and then put another bullish strategy, because there'll be a repricing, and then you see like this flow coming in, or maybe heading into earnings. And these are from a historical perspective. Obviously, we don't know. That doesn't give you any guarantees for future results. These are some things that you could go back in history and kind of take a look at it and see that, given a strategy and its volatility, right, the risk, and make a decision based off that trade-off.
Let's talk about implied volatility for a second. How does implied volatility typically behave in the weeks leading up to earnings announcements? And what sort of strategies can benefit from that pattern that you would see in the screening tool?
Yeah, if we take let's say the option pricing model, Black-Scholes, what you'll see is, and calculate the implied volatility looks like it's increasing heading into earnings. And then after the earnings announcement, you'll see a big drop, because it's heading right back to where typically will be priced without an earnings event. So that's something that you would observe. And the reason though behind that is that also options, they have a component for this gap, right? Heading into earnings, what you will see is that there's a high uncertainty. So you're going to have this component in there that is going to be priced in until the end of earnings. And as you get closer, it looks like the implied volatility is moving higher. And it's important then to look at the premium of the options to compare to that expected. From that perspective, when we look at implied volatilities, traders have to keep in mind that the options themselves are pricing in just average daily volatility from now to expiration. They have this one component in there that is looking at a specific event that will get taken out after that event, after the announcement of that event, and stock gets repriced.
Historical data is never perfect, right? If it was, we'd all be super rich and not have to worry about anything. There's always, there's definitely outliers and other issues that pop into it. How can traders distinguish between the statistically significant patterns and then also these like random one-off occurrences that almost, I think it's safe to say, appear from many stocks, if not all, if you go back far enough?
Yeah. It's a good question. How do we look for outliers or something that may skew the data, let's say? And that's very important too, because if you look at it and let's just say, for example, we're looking at an average movement of a stock after it reports earnings, and we get this average, say 10% up or down. But if we look at that data, we have this really big move in one of those earnings, 25% it moved up. And that will obviously skew our averages higher. And if we look at that data point, it could be an outlier. It could be something where something special happened in that earnings, where let's just say we go back and we find out that that particular earnings, they announced the results of a lawsuit that was going on for 2 years. That's like an outlier. We could say that if that doesn't happen every quarter, right, we can't expect a movement like that. And you might want to remove that from your data set, and you might get a much different metric. Maybe not a 10% average, but it could be a 5%. So it's something to really keep in mind. Yes, when you're looking at the data sets and you're running your analytics and you're trying to establish some kind of modeling around your potential opportunities, potential returns, or your potential risk, looking for those outliers becomes important. And you definitely want to take those into account. If there's an outlier, you could explain it away based on something like we just discussed.
And how can traders balance win frequency versus the average return versus best case, worst case scenarios when evaluating these historical option strategies when they're
Yeah.
taking a look at it?
Yeah. And when we run these statistics and metrics, they work together in some sense, and they answer different questions. Like when we mentioned win rate, we want to see how often does something happen, the frequency of something happen. How often does the stock move beyond 10%? How often does the stock gap up or gap down historically? Or so that's just looking at the historical frequency of something happening. And then we could look at the average returns, best, worst case scenario. That's looking at the magnitude of it, right? That's looking at what, potential movements, what kind of potential movements can we get ranges from a historical perspective, because we don't know the future outcome, of course, but using a model, we plug in the data that's available so we could model out the potential movements from zero to wherever. So these are things that they're important. They answer different questions and work together.
And time premium is such an important part of option pricing. What role does time decay play in the profitability of options, the strategies during earnings, particularly when you're looking at implementing different positions at different distances from the announcement date?
Yeah. So with and that's a good question, because when you have an option that, let's say, covers earnings, you're going to have that component for gap that's not going to decay until that announcement is made. So you're not going to see a typical decay in that option. If we plug it into the option pricing model, we're going to get this theta number. And the theta number doesn't really reflect a component for a binary event, right? It just says that this is going to decay X amount every day or whatever on the day. So when we look at time decay that involves an option with a binary event like earnings, it's not going to decay the same way as an option that doesn't have that component for a binary event. And so when we look at that theta number, it's not the same, right? Until you take that component out. So if where you're looking at stuff, that's where G's having that in mind and take that into account.
And Dmitry, could you discuss the process of validating strategies' effectiveness across multiple earning cycles? What statistical measures should traders use to confirm whether these observed patterns are meaningful or if it's just a big coincidence, right? Like you're just looking at the last couple of earnings and I guess it's just happened to go this way.
Yeah. So when we look at a strategy, for example, an option strategy, what we try to do is look at the market price of the strategy, right? Because the market price of the strategy reveals some, right? It reveals to us what the market thinks the likelihood of something happening and what the payoff potential could be, right? So we look at that from the perspective, and then we try to analyze it and compare it to what we believe it could be. And when we look at it, it's not really the effectiveness of it, but what we believe the pricing of the strategy at this point. Does it offer some type of an opportunity relative to what we believe? So I'll give you an analogy. If I'm looking at an outcome of a football game and I have no idea if team A or team B will win, and if I'm assuming that there's a equal chance of either team A or team B becoming the winner of this football game or soccer game, whatever. And what I observe is that somebody is handicapping one, right? They're giving you 5 points or 10 points or something. Then that could be an opportunity, because of that would indicate that there's a good risk reward in the market at this point, right? So the markets are always pricing and repricing. And what you're looking at is how is it priced? What is it indicating? And how does that compare to my particular outlook or payoff?
Dmitry, this has been great. Are there any final thoughts you'd like to leave our listeners with?
Yeah, I think that with options trading, a lot of people are using options trades for earnings because we do see a big boost in volume typically around earnings, and to use those historical levels, right, or historical data, and even in screener like the you're discussing, to help just with your analysis, your opportunities, potential risks and rewards going into those potential positions. So just something traders should be considering if they're about to take a options position around earnings.
Again, thanks for coming by. For our listeners, you can find more from Market Chameleon on our website under education. You can find webinars, articles they've written, podcasts. They also run a morning show every day, Monday through Friday on YouTube. And again, I always love you coming in once a month to discuss everything options. Until next time, I'm Jeff Praisman with the Interactive Brokers.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or OD, which may be accessed through the link found in the podcast description page.